Hi everyone, this is Rob Roy of Elliott Wave Options and welcome to the U.S. market update. Well, last time we talked about how Thursday could be a pretty wild day as we were going to get the ISM non-manufacturing report to come out following a manufacturing report that had been shockingly bad. And the first hour was pretty wild. We opened and kind of hung around. The number came out at 10 o'clock Eastern time and we sold straight down. And then I guess people started realizing, hey, yeah, the number is showing some weakness, but it's not as bad as they thought it could have been. It certainly wasn't as shocking as the manufacturing number had been, which was going back to 2009 recessionary levels. So all the sectors showed a reading above 50. The 50 is the important level when you look at these reports. Anything above 50 shows expansion or growth. Anything below 50 shows contraction. So that would be a weaker sign. So we came in right around 50 on some aspects of it, but just above it. So we were technically in the growth phase, just slower growth. So I think everybody kind of figured out, well, we knew that already. We knew that growth was slowing. And so the market turned, kind of rallied back throughout the rest of the day. And then as you'll see in the charts, we moved up and filled that gap that we were talking about as one of the possibilities. One other thing before we get to the charts, this week the importance is going to be starting on Thursday, where talks are supposed to resume between the U.S. and China. There was some preliminary talks that started today, but the most important part is supposed to get underway on Thursday. So there's some nervousness, some excitement, some speculation as to what kind of news could come out of that. Some people thinking that maybe President Trump, with all this other stuff that's going on around him, might like to have a positive news item to talk about, and so maybe they at least come to some sort of a mini deal some are talking about, or maybe they agree to indefinitely suspend the tariffs to keep talking, or maybe the talks fall apart altogether. Who knows? But there is a little bit of hope that something substantial will happen. And then, of course, I think with the weaker economic data, some people are a little skittish about maybe going too strong to the downside, thinking that the Federal Reserve could step in with some more quantitative easing, or possibly a 50 basis point rate cut rather than the 25 that's already priced in. With that said, let's get to the charts. So taking a look at the chart of the S&P 500, we talked about the fact that we had this gap and that we know gaps get filled, just no rhyme or reason as to when. And then we had the trade on Thursday where we opened, traded lower, looked like, here we go. The whole Katie bar the door to the downside that I was talking to you potentially about. And then the rally back as people realized, hey, it's not so bad after all. So we moved back to the upside, and then here we go on Friday actually filling the gap. So we got that gap filled. And then the interesting thing from an Elliott wave standpoint is we had the breakout of the triangle. We talked about the fact that part of Elliott wave analysis is that when you break out of a triangle, quite often that gets retraced. And so we've done that. We retraced it all the way right back to the point of where the initial breakout was. So where do we go from here? That's the question. And the answer is not quite as clear. We are at that wave 5 high. We're right at the Fibonacci 61.8% level. But coming back and fulfilling the corrective patterns, and I like to look at those because they're shorter term. Elliott was big on those, so corrective patterns, waves within waves, corrective patterns within larger waves, and that's what we have going on here. So we're still in the same kind of area that we were last week, where we have the potential to move to the upside if we get some sort of a positive resolution to that U.S.-China trade negotiation that's occurring this week, or if the Federal Reserve starts to hint. Maybe some of the governors come out and start speaking, and maybe it looks like there will be that 50 basis point cut rather than 25. Again, the market expects 25, so we figure that's pretty much baked in. But the data was weaker, even though the non-manufacturing data wasn't as bad as expected. Definitely showing things getting weaker, and I don't think the Federal Reserve wants to see the contraction come in. So from an Elliott wave standpoint, we're in one of those areas where you kind of let the next phase set itself up, and then you have a bit more confidence of where things could go. Taking a look at the VIX, just wanted to update that. Same rules apply here, which is interesting as far as the triangle. You had the triangle formation, and we talked about the fact there was room to break out to the downside. So what happened? We broke to the downside and retraced the breakout. Plain old Elliott wave rules on corrective triangles. The breakout is quite often retraced, and usually in a fairly short period of time, and that's exactly what happened there. So we're not getting a whole bunch of a reading here on where the VIX could go from this point either, and you can see that it's labeled with the corrective ABC, so not telling us a whole lot. I thought we'd update the chart on TBT, and you can see here's one thing that's occurring is interest rates are just going down. Many reasons why that's occurring. Weakness in the economy, weakness globally. We're the only positive yield, so everybody is buying our stuff, on top of the fact that we have the Federal Reserve that's doing those repo agreements, adding liquidity, going to cut at least 25 more basis points, possibly more than that. There's just really not a whole lot to hang your hat on as far as rates turning and going to the upside. So these little bounces that occur seem to be short-lived, and we talked about that. That I just consider that to be a blip in the overall impulse pattern to the downside, because it was only at 20, call it the 23% Fibonacci retracement level there. So it looks like we are headed significantly lower. A lot of speculation that we're going to go to zero rates. Chairman Powell has said that he doesn't see that. He doesn't see negative rates, is exactly what he said. I guess he didn't technically say he didn't see rates going to zero, but we sure seem to be following in the same footsteps that Japan did, and they went into an awfully long malaise because of that. So not sure that's the greatest thing to do. I've been on record of back in the financial crisis 2008 and 9, we should have just raised rates then and really felt the pain, cleared out all the excesses that we've had. We could have put a big dent in the debt issue that we have here in the U.S., and we didn't do it. So that's the way it goes. The other thing I wanted to show you is UUP. We could do a whole another session on that financial crisis and getting out of it by doing more of what got us into it in the first place. They just flooded the system with liquidity, and that's what had originally gotten us in. So here is a symbol UUP. This is an ETF that people can trade, which coincides with the US dollar. Rather than trading the actual currency itself, you could actually just trade this ETF. It's fairly liquid. And you can see where we have come right up here to that wave 5 target. Isn't that amazing? Right to the top of the tap box here. Right there, hit it right at the 61.8% fib extension, a logical point of resistance, and it has been, and we bounced down. But the issue here is what's gone on with the dollar is the dollar has been very strong, and all the companies that do business internationally don't like that because it makes the exchange rate unfavorable, and it's tougher to make money on the international scene when you have a strong currency, and when all the other countries are all racing to have the weaker currency, and we've got our CEOs and the president talking about the dollar is too strong. I know that sounds weird, just to be upset about your currency being too strong, but it does affect international commerce. So I did want to show you that. Now, the one reprieve that may occur there is with the dollar hitting that major point of resistance, we get the wave 4 retracement. So we come back down here to this wave 4, and that would ease pressure on the dollar a little bit. That could be some ammunition, along with potentially the Federal Reserve cutting rates more for the market to take another run at those highs. So it'll be fascinating to see how that plays out. But just wanted to show you that. We hadn't looked at this chart in the past and show you that possibly we're at a point where the currency, the dollar, could weaken a little bit, and that should be positive for the markets. So it's going to be an interesting week with the China trade. So all eyes will be on China for this coming week to see how the talks go, and we'll be back to report it to you. Take care, everybody.